About 7 months ago, I made a video titled, "Is Meta Platform stock cheap enough yet?" And pretty soon after posting that video, I sold my entire stake in Meta Platforms. And boy, in hindsight, was that a good decision. Since I sold, the stock is down over 50%, with much of that decline coming just today after the bloodbath that was Q3 earnings. So today, I'm going to be taking a look at Meta Platforms' Q3 earnings alongside Google or Alphabet's Q3 earnings. And I'm also going to revisit the question that I originally asked 7 months ago. Is the stock cheap enough yet? Before I get into the meat of this video, where I want to talk about the short-term and long-term headwinds for Meta and Google and how some of those headwinds are similar and some of them are different, and I think that's going to form a lot of the value in this video, I do want to jump into some of the headline numbers just to give you a snapshot of where these businesses are today, especially in comparison to where they were a year ago when the ads market was extremely strong. For the quarter, Google reported revenue of $69 billion, which was up, but only 6% year over year. Revenue growth was driven by a 4.25% year over year increase in Google search revenue. YouTube ads actually fell by 1.9% year over year, and Google network advertising also fell 1.6% year over year. Google Cloud, which is a small part of the overall Alphabet and Google ecosystem, continued to grow at an exceptional rate, although it's not yet profitable for Google. Cloud revenue rose almost 38% year over year to reach almost $7 billion. And similar to a lot of businesses that operate out of the US but have global operations where they collect a lot of revenue in foreign currencies, these businesses have faced rising costs in the US, coupled with some foreign exchange conversions that have gotten a lot worse when collecting revenue in euros, for example, that has gotten relatively a lot weaker compared to the US dollar. And that, on top of a bunch of other issues, including labor, cost inflation, and a bunch of other supply side issues, means that Google, even though they increased their revenues, their costs rose at a faster rate, meaning their profitability was down year over year. To be specific, net income came in at just under $14 billion, which was down from $19 billion in the same quarter last year. In terms of some of the important key business indicators that we can look for to assess the, health of their advertising business, they had an 8% rise in paid clicks, but a 5% reduction in the cost per clicks. And Google cited that this was mostly the result of an increase in search volume, so people using Google search more often, therefore there's more places for advertisements, more digital real estate for advertisements to be placed, in combination with a continued move for people spending more time browsing and using search and YouTube and that sort of thing on mobile devices rather than on desktops, which monetizes at a far lower rate, which is why their cost per ad has been going down, even though people are using the platform more. Part of this effect of being able to display more ads but receive less revenue per ad is also likely being fueled by the adoption of YouTube Shorts, which they mentioned on the earnings call that they now have 1.5 billion monthly active users on YouTube Shorts, which is crazy. YouTube Shorts does run advertising, but the same as Reels and TikTok. It monetizes at a far lower rate, and these ad businesses actually haven't even fully ramped up their ability to serve ads on those platforms yet. So the combination of the fact that the ad is far smaller, you're viewing the ad for far less time, and the fact that these platforms are still ramping up their monetization means that they're receiving far less revenue per ad, even though there's actually more ad placements. There's actually more impressions because you're seeing more ads more quickly than if you just watch a YouTube video, for example, and you might see 3 different ads at different, or ad breaks, for example. But those ads, advertisers, I should say, are paying far less for those placements. And there was some very similar kind of features around the quarterly earnings to Meta's business as well. Meta's revenue came in at $27.7 billion for the quarter, which is actually down 4% year over year. Similar to Google, their ad impressions were up and the cost per ad was down, but it was far more dramatic than Google. Ad impressions were up 17%, while the average price per ad was down 18%. Short form content is such a central part of Meta's advertising business, as most of their ad revenue is coming from Instagram, and within Instagram there's a massive shift away from stories and feed towards Instagram Reels. And again, very similar to Google, Zuckerberg spoke about how this is driving higher ad impressions. So they're able to run more ads, but they monetize at a far lower rate, which essentially means, as Zuckerberg said, they're essentially displacing revenue or larger revenues as people shift away from stories and feed towards Instagram Reels. Again, Facebook faced some foreign exchange impact, although it wasn't really that much. I think it was just 2%, I think they mentioned. But of course, Facebook is also, or Meta, I should say, is investing investing a lot into their Reality Labs business, and that actually meant that their research and development costs were up a massive 50% year over year, and their other costs were up somewhere between 10 and 12%, and overall it meant that they had an almost or more than 50% decline in their net profit figure for the quarter. So clearly both businesses are struggling, and a large part of that is actually in relation to short-term factors that actually probably doesn't affect their business too much over the long term. And one of those key factors is the extremely tough macroeconomic environment that they're both operating in right now. 2022 has been a tough year for businesses. Interest rates are rising, and that has had a huge ripple effect through the economy. And for two businesses like Google and Meta, they don't have a lot of debt themselves, so maybe they're not feeling it on the interest rate side, but they do a lot of advertising for a lot of businesses. And advertising is one of those things that a lot of businesses have a set budget for advertising, and when costs are rising and revenues are getting, margins are getting pinched, advertising is one of the first places that a lot of businesses look to cut in order to protect their businesses. So in tough economic circumstances like we're seeing right now, it shouldn't be surprising to see advertising revenues struggle to grow, or at least grow at a slower rate than previously. But between the two businesses, clearly Google is weathering this storm a little bit better, because Google is still continuing to grow, whereas Meta is actually already in reverse. So what's the difference? Why is Google seemingly, at least right now in this quarter, in a better position than Meta? There's a bit of a debate about what this could be, but I think there's really two core issues here, two core distinctions between the two businesses. The first is ad tracking. So Facebook and Meta platforms relies very heavily, or has at least for a very long time, on third-party tracking. So being able to track customers and clients through external websites and across apps. And that's something that's kind of grinded to a halt now that iOS, iPhone, Apple have introduced this change that protects users' privacy and essentially makes it easy for people to opt out of that kind of tracking. And this change went through a long time ago. It started, I think, 18 months ago, but it is something that's going to take time to see the full impact, because essentially what it means is businesses' advertisements are going to be less effective. They're using less data, there's less tracking, so they're going to be less effective, and that's something that businesses will watch over a long period of time. And it might take some businesses a long time before they move their advertising budget away from Facebook to more effective means, such as advertising through Google search, for example. Google really doesn't use that much third-party data for their tracking, so there's really no threat if a law was passed that stopped third-party tracking, or they're not threatened by iOS making the change, because Google has a huge amount of data that they can draw on. They have Google search, they have YouTube, they have Android and all of the Android apps that people use, so Google Maps and all of these things. They have so much data that they internally own that they can use to provide effective advertisements, and they can provide those effective advertisements on other people's websites, because Google also controls a large part of the network advertising market. And the other issue is that Facebook is much more exposed to this shift in engagement towards short form content. While Google's advertising business is extremely diverse, search is a critical part of their business and can't really be impacted by people spending more of their entertainment time on shorts. Facebook, on the other hand, most of their advertising is through these social apps. And as social apps move towards short form content, most of their advertising is going to be through short form. So there's a much larger shift that's going on within Facebook's advertising business than within Google's. Now, Google will be exposed to this. Certainly people will maybe spend less time watching normal YouTube videos and more on shorts. That's certainly something that's possible. But YouTube is kind of more grabbing more engagement from other social platforms like TikTok, whereas Facebook is just displacing their existing users who are watching, using the newsfeed and stories where ads were, where they could charge more for ads instead of on Reels. So when I think about the question, is Meta Platforms cheap enough yet? It's really not even, first of all, no, but it's not even a question about valuation for me. It's not about how cheap the stock gets. And I see a lot of people talking about, well, it keeps getting cheaper and it keeps becoming more attractive relative to their current cash flows. To me, it's not even about that. I can't even look and compare their price to cash flows because their business to me is so uncertain. I don't know how they're going to be able to monetize Reels in the future. I don't even know how they will compete against Shorts and TikTok. So how much engagement they will even draw from that business. And I don't know whether Facebook ads will be anywhere near as effective as Google's ads with the far less amount of first-party data that they have to provide targeting. And those two things essentially mean that as the business currently exists, there's no price in which I would buy Meta Platforms because I don't see a clear path for cash that can be returned to me in the future. And some of these differences has actually been why Google has been priced at a premium compared to Meta historically. But I should mention that while I have a lot of uncertainty in regards to Meta, I don't feel the same way about Google. Google, the reason why I haven't invested into Google yet has been based on valuation, and that story is beginning to change. So Google is becoming a lot more interesting to me. It's not quite there yet, and I've got some work to do in terms of learning more about some of their additional businesses that are growing quickly, such as cloud. But I see the two businesses very, very differently. I used to look at them as this kind of duopoly of the advertising market that's just going to slowly capture legacy advertising. Now, I'm not so sure about Meta's ability to even maintain their position in the global advertising market. If anyone's interested in seeing I think I've done about 6 hours in total of analysis presentations on these two companies in my community, and I do these analyses to kind of demonstrate how I'm applying Warren Buffett and Charlie Munger style value investing principles to businesses. If you're interested in seeing my super deep thoughts on these companies and how I value them and how I think about their competitive advantages, then consider joining our investor community. It's linked down in the description below. But with that said, hope you guys enjoyed today's video, and I'll see you in the next one.